friends, how are you? Today we will be discussing about something which is relatively new to the Indian market and for Indian investors. That is real estate investment trust, or we call it REITs. So, what are these REITs? REITs are normally a company that owns and operates real estate to generate income. Real estate investment trust companies, they are corporations that manage the portfolios of high-value real estate properties and mortgages. For instance, they lease properties and collect rent from them. So the rent thus collected is later distributed among shareholders as income and dividends. So you will see that they are more like mutual funds. So they allow an investor to invest in real estate assets without necessarily owning a property. So many a times we are not investing in properties because we don't have enough capital. So even investing in a small property or investing in real estate requires large sum of money, and that normally discourages people from investing because they said we don't have money, we don't have the capital to invest. And then there are other problems like the land laws. They are not very clear in India, so there are many disputes, and these disputes, if they go into the litigation, they are dragged for years. So these complexities, and then also you have to pay taxes and the maintenance of the property. So people who are normally people who are transferred regularly, they hesitate to invest in real estate because of these issues. Who will rent the property? Who will pay the taxes? Who will be maintaining it? Who will buy it when you are not around? And who will take care of the property? So these are the issues. But REIT is solution for all of this. So if in a simple language, it is a company or institution that collects money from investors. So you invest money in REIT, then they will use it to manage, maintain, or sell real estate properties. So what they will do, they will manage, maintain, and sell real estate properties, and then they will distribute these profits, like whatever rental income they are getting, or whatever profit they have generated from selling the properties. So this all will be distributed among the investors. So REITs they behave like mutual funds, and that they pull the money from the investors with common investment objectives, like investing in real estate. They have the common objective, and then they invest that money in market-linked instruments. So what are market-linked instruments? The real estate market-linked instruments. So this is the definition. So I hope you might have understood. Now let us see what are the types of real estate investment trust, that is REIT. So the first is equity. This type of REIT is among the most popular ones. Typically, it is concerned with operating and managing income-generating commercial properties. So the REIT will buy income-generating commercial properties, and then they will go on to lease it. So the rental incomes will be then distributed among the shareholders or investors. So notably, the common source of income here is rents only. Now moving on to the other types. So other type is mortgage. Now mostly these type of REITs, they are mostly involved in lending money to the proprietors and extending mortgage facilities. So when they are suppose somebody needs money, so they will mortgage their properties with REITs, and then REITs will finance them, and they will generate income in form of interest accrued on the money they lend to the proprietors. Another type is device, that is hybrid. Now, if you want the benefits of both options, equity as well as mortgage, so this hybrid option will allow you that. This option allows investors to diversify their portfolio by parking their funds in both mortgage REITs and equity REITs. So there is another type of classification also, that is on the type of ownership. So how are REITs owned? So who is the owner of the REIT? So there are some private REITs, those who are not publicly available to the people, and very small group of people manage them, and they can be a part of REIT. They are private REITs. Publicly traded REITs, so now publicly traded REITs, these are SEBI registered and SEBI recognized REITs, and they trade on stock exchanges, normally NSE. So they have shares and they trade on NSE. So they are very liquid. But the one problem is that they are very prone to market fluctuations. Another kind of REIT is publicly non-traded REIT. So these publicly non-traded REITs, they are not registered. They are not registered on stock exchanges, but they are recognized by SEBI, and so they are a bit more safe because the SEBI regulates them, and they are also not very prone to market fluctuations because they are not trading on the stock exchanges. So now we will see what are the advantages and limitations of REITs. So if we talk about advantages, first we'll see what are the positive sides. So as we said, they generate higher returns. So normally the REITs, they generate income in the range of 10% historically, and in the long run they give very good return. So people who want to invest in who don't want to invest in shares, but they want to generate higher returns better than the FDs, REITs are for them. Now, steady income. So suppose a property is lent, and normally these are commercial properties, so they are lent for longer terms. So the income is normally steady, and if this income is distributed to shareholders, so there is no issue. You can be getting good income over the years. Flexibility. Now, especially for publicly traded REITs, they normally trade on stock exchanges, so they are very flexible also. Normally, it is very difficult for an investor to exit an real estate investment. You have to get a buyer who also have a large capital, and then there will be price fluctuations issue also. But here you can just sell like shares and exit the investment. So that gives you flexibility also. Now they are very strictly regulated. Since especially for the kind of REITs, publicly traded and non-publicly traded REITs, they are registered by the SEBI. So this ensures that they maintain transparency and accountability towards their investors. Now, REITs allow the fourth is real estate investment. So this allows you for investment in REITs in even less than 500 rupees. So you can start your real estate investment in 500 rupees. If you see other than REIT, if you want to invest in real estate investment, there is no place you can invest in 500. You need minimum amount in lakhs and even in crores nowadays. So that is another major benefit. Now, portfolio diversification. We know that we should not keep all our eggs in one basket. We should diversify our portfolio. Some can be in equity market, some can be in FDs, and some can be in REITs also. Now, REITs will allow you to diversify without taking the risk of real estate investment, like I had discussed earlier. Now, tax-free returns. So REITs are designed to provide partially tax-free returns. They are not totally tax-free. They are partially tax-free. When a REIT company receives rental profits and distributes them to its investors, they are treated as pass-through entities, and hence they do not attract tax. So these are the benefits. You will see there are many. Now we'll see there are some limitations of the REITs also. We'll discuss them. So the first, what are the disadvantages? The first is returns are not guaranteed. So like any other stock or mutual fund, returns are not guaranteed. So if you are totally risk averse, you should not go for the REIT. However, these investments, they are relatively less riskier than the other investment horizons. So they carry lower risk, but they are not totally risk-free. Returns are sensitive to interest rate. So like other real estate investment, whenever RBI, they change their repo rate from time to time, they are changing. Whenever they change, that affects the interest rate directly, and the impact on returns generated by REITs also are affected. So when the interest rate increases, the value of the REIT stocks are usually decline, and when the interest rate is decreased, the vice versa happens. So it is related to interest rate cycle, and thus that affect the performance of the REITs also. Tax on dividend. So we had just discussed that they are not totally tax free. So and they come under the long-term capital gain and short-term capital gain, and then of course you have to file a tax on the income received as income tax to the authorities. Now, slow growth. So normally they are only suitable for investors with the long-term horizon, because the real estate, it gets appreciated only in the long run. So if you want a short-term and quick money, REITs are not for you. So they are slow growth investment options, and you have to have longer term horizon, minimum of 7 years, 10 years, if you are investing in REITs, and you should not think them as shares and that you will just go and buy and tomorrow you are selling. So as we have discussed advantages and limitations of REIT, now let us see what is the conclusion, what we can say about REIT. So REITs are usually good for long-term investors who are looking for decent return. However, one should research for the best REIT to invest in before investing in their hard-earned money, and you should have a long-term horizon. Then only you should go for REITs. Otherwise, you can go for other available options like stock, mutual funds, and if you have money, you can go for the direct investing in real estate also. So I hope this video will increase your understanding about the REITs, and for viewers' knowledge, we came with this video. Now we'll be coming like videos like this in our next videos also. So if you are an investor or you want to stay updated about the new horizons of the finance, I will request you to like, subscribe, and share our channel. And I'll be back with the next video very soon. Thank you so much. Bye bye.